Good afternoon, ma'am. Good afternoon, classmate. I am the last reporter of Chapter 15. So, death to Dividend Reinvestment Plan. During the 1970s, most large companies instituted dividend reinvestment plans, or DRIPs, under which stockholders can automatically reinvest their dividends in the stock of the paying corporation. Today, most large companies offer DRIPs, but participation rates vary considerably. There are two types of DRIPs. First, plans that involve only already outstanding stock. And second, plans that involve newly issued stock. In either case, the stockholder must pay taxes on the amount of the dividends even though stock rather than cash is received. So, under both types of DRIPs, stockholders choose between continuing to receive dividend checks versus having the company use the dividends to buy more stock in the corporation for the investor. Under an old stock plan, the company gives the money that stockholders who elect to use the DRIP would have received to a bank, which acts as a trustee. The bank then uses the money to purchase the corporation stock on the open market and allocates the shares purchased to the participating stockholders. Accounts on a pro-rate basis. The transaction costs of buying shares are low because of volume purchases. So these plans benefit small stockholders who do not need current cash dividends. A new stock DRIP invests the dividends in newly issued stock. Hence, these plans raise new capital for the firm. AT&T, Xerox, and many other companies have used new stock plan to raise substantial amounts of equity. No fees are charged to stockholders, and some companies have offered stock at discounts of 1% to 10% below the actual market price. The companies offer discounts because they would have incurred flotation costs if the new stock had been raised through investment banks. So, summary of factors influencing dividend policy. So, in earlier section, we described the theories of investors, preferences for dividends, and the potential effects of dividend policy on the value of a firm. We also discussed the residual dividend model for setting a firm long-run target payout ratio. In this section, we discussed several other factors that affect the dividend decision. These factors may be grouped into four broad categories. First, constraints on dividend payments. Second, investment opportunities. Third, availability and cost of alternative sources of capital. And fourth, effects of dividend policy. So, constraints. First is bond indentures. Debt contracts often limit dividend payments to earnings generated after the loan was granted. Second, regulatory requirements. Companies in regulated industries may face direct or indirect limitation on their ability to return cash to shareholders. Third, preferred stock restrictions. Typically, common dividends cannot be paid if the company has omitted its preferred dividend. Fourth, impairment of capital rule. Dividend payments cannot exceed the balance sheet item, retain or return earnings. Fifth, availability of cash. Cash dividends can be paid only with cash. Thus, a shortage of cash in the bank can restrict dividend payments. 6. Penalty tax on improperly accumulated earnings. To prevent wealthy individuals from using corporation to avoid personal taxes, the tax code provides for a special surtax on improperly accumulated income. Then effects of dividend policy on RS. The effects of dividend policy on RS may be considered in terms of four factors. First, stockholders' desire for current versus future income. Second, the perceived riskiness of dividends versus capital gains. Third, the tax advantage of capital gains. And fourth, the information or signaling content of dividends. We discussed each of those factors earlier. So we only note here that the importance of each factors varies from firm to firm depending on the makeup of its current and possible future stockholders. So it should be apparent that dividend policy decisions are based more on informed judgment than on quantitative analysis. Even so, to make rational dividend decisions, financial managers must take into account all the points discussed in the preceding sections. So, effects of dividend policy on RS. The effects of dividend policy on RS may be considered in terms of four factors. First, stockholders' desire for current versus future income. Second, the perceived riskiness of dividends versus capital gains. Third, the tax advantage of capital gains. And fourth, the information or signaling content of dividends. We discussed each of those factors earlier. So we only note here that the importance of each factor varies from firm to firm depending on the makeup of its current and possible future stockholders. So it should be apparent that dividend policy decisions are based more on informed judgment than on quantitative analysis. Even so, to make rational dividend decisions, financial managers must take into account all the points discussed in the preceding sections. So, stock repurchases. Several years ago, a Fortune article entitled "Beating the Market by Buying Back Stock" reported that during a one-year period, more than 600 major corporations repurchased significant amounts of their own stock. It also gave illustration of some specific companies' repurchase programs and that the effects of these programs on stock prices. The article's conclusion was that buybacks have made a mint for shareholders who stay with the companies carrying them out. So more recently, as we noted in the opening vignette, Apple Inc. has established a quarterly dividend and has repurchased shares of its common stock. Apple's recent action are part of a larger trend in which many leading companies have repurchased stock. In just the first quarter of 2014 alone, companies in the S&P 500 increased share purchase by 29% from the prior year. How do stock repurchase programs work and why have they become a prevalent over the past several years? So we discussed this question in the remainder of this section. So there are three principal types of stock repurchases. First, situation where the firm has cash available for distribution to its stockholders, and it distributes this cash by repurchasing shares rather than by paying cash dividends. Second, situation where the firm concludes that its capital structure is too heavily weighted with equity, and it sells debt and uses the proceeds to buy back its stock. And third, situation where the firm has issued options to employees, and it uses open market repurchases to obtain stock for use when the options are exercised. So stock that has been repurchased by a firm is called treasury stock. If some of the outstanding stock is repurchased, fewer shares will remain outstanding, assuming that the repurchase does not adversely affect the firm's future earnings. The earnings per share on the remaining shares will increase, resulting in a higher market price per share. As a result, capital gains will have been substituted for dividends. So that's all. Thank you.